always thought that a big part of generating good long-term returns starts with protecting clients' capital from the risk of loss. Our investment teams have always had a consistent investment process, which has emphasized owning high-quality businesses that are led by competent management teams and managing risk through valuation, balance sheet, and diversification. More than anything, we think our strategy's differentiated return in recent years has really been driven by managing risk and downside in a broader market environment where investors really haven't been concerned with either. For example, if we look at our global equity strategy, even though it had a hard time keeping pace with buoyant market conditions driven by a few large growth stocks in 2023, a big part of the fund's outperformance over the past few years was driven by much more reasonable starting valuations than the stock market in 2021 and 2022, and a greater diversity of opportunity, which really helped the fund protect clients' capital and generate a positive return in that year when the market was down over 10%. Investors may find it interesting, but if you look across any of the funds that we manage, the performance outcomes have been remarkably similar, all generating positive returns in 2022 when the market was down significantly. This trend's not too dissimilar from 2008, when our funds had significantly smaller declines than major stock markets, or even look to the experience of our small cap fund in the aftermath of the tech bubble in 1999 or 2000, when the market was down sharply for a couple of years, but QV's small cap fund was up significantly in subsequent years. That QV's been able to protect clients' capital in all of our different strategies over multiple periods is, I think, really a testament to our investment process. So we've never taken strong positions in the near term, but we believe the range of outcomes today in the current environment is much wider than equity markets are currently discounting. We think there's potentially a contradiction occurring in markets today. On the one hand, investors' expectations have lifted equity valuations in the US to historically high levels on this consensus view that corporate earnings growth will reaccelerate in 2024. On the other hand, there are numerous late cycle indicators which suggest the economy is weakening against persistent inflation. If we look to the first quarter data, US GDP was weak at just around 1.6%, and we continue to see deterioration at the margin in areas like consumer credit and full-time unemployment trends. While US corporate earnings growth remained robust in the first quarter, we actually noticed a deceleration in growth in economy-sensitive businesses, which are typically indicative of the trend in corporate and consumer spending appetites. Looking across the ocean, corporate earnings results in Europe have been a little bit more muted alongside relatively minimal economic growth. While we don't necessarily know the outcome, we're always wary of high valuations backed by elevated expectations against the context of an uncertain economic backdrop. We do think, however, that the balance of risk today is tilted to the downside rather than the upside. So in the fall of 2020, we felt that the differentials between highly valued growth stocks and many parts of the market had reached such an extreme that it seemed quite difficult for more value-oriented strategies such as ours not to perform well given the discounts that we were finding in high-quality businesses that were out of the limelight of the major growth stocks. At the same time, it was becoming apparent that both interest rates and inflation were likely to rise from low levels, and these were factors we felt would help to support both the earnings and valuations of depressed value stocks, and also likely to suppress the excesses of very highly valued areas as investors began to incorporate a higher cost of capital versus the prior decade. Fast forward to today, and although it's been an attractive environment for value-conscious investors like ourselves, many of the same conditions continue to persist. If we look to 2023 for context, the Russell 1000 Value Index underperformed the Russell 1000 Growth Index by 31%. This was the second worst outcome since 1979. Meanwhile, the median stock in the S&P 500 underperformed the index by 16%. This was the worst underperformance since the heights of the tech bubble in 1999. And not coincidentally, the NASDAQ 100 rose 55% in the year in 2023, the most since 1999. So the market environment today really remains one of extremes. The historical record over the last 8 or 9 decades paints a pretty clear picture of what we might expect for future prospects for some of these very highly priced areas of the market today that are dominating the market indices. And if history is a guide, it's not a very attractive outlook. In contrast, however, at QV, we've remained very disciplined in managing and avoiding many of the risks we see in the market today. This doesn't mean our strategies won't avoid volatility in a scenario where markets decline in a recession, but we do think we've avoided the excesses that could result in permanent capital loss or very unexceptional outcomes in future years, which we think a lot of businesses today may be currently priced for. If we look to our global equity strategy, for example, the strategy trades at just 14.5 times earnings with a 2.9% dividend yield. This is near a record-wide discount to the market, despite having stronger balance sheets and a more attractive return on invested capital. That we're able to continue to build such a differentiated, well-valued portfolio today suggests to us that we're still in the early innings of what's likely a multi-year period where investors who are risk-conscious and focus on paying reasonable prices versus a growth at any cost mentality are likely to do quite well.